Good afternoon. At these sort of events, you often hope that everything goes according to plan. And for those of you that have visited our stand, you'll notice there isn't actually a stand. So unfortunately, thanks to a lorry driver in France who never quite made it this morning, it's just a few of the team and some posters. So apologies for that. I wanted to start with probably a very exciting bit, which is that crowdfunding currently is returning to investors in excess of 12% per annum. Net to investors, that's around 7 to 10%. Now that's quite interesting given the fact that stock markets at the moment are flat, some are slightly down, some a little bit up. Bond yields aren't particularly interesting, and currencies, especially sterling, strengthened and then weakened. Sorry, weakened then strengthened. So with that backdrop, I wanted to just highlight another point before we go into the details of crowdfunding. Many of us are in what I consider a reasonably privileged position. We've got enough food to put on the table, enough money to put a roof over our heads, and we're in a position where we have surplus capital that we want to invest. Now that's a position of responsibility that many of us take quite seriously. But is investing our money simply about making a return, be it in a short term or long term, or should we be looking for something more? I think we should, and I'm going to explain to you why. 10 years or so ago, I was an investment banker, and I ran a large proprietary trading book for a big investment bank. And I was a technical trader, so I was looking at things like dispersion, correlation, volatility, deviations away from the mean, moving averages. Now, I ran a very successful book, and the bank was making quite a lot of money off the back of the portfolio. But it got to a point whereby I was investing tens, if not hundreds of millions into businesses I knew very little about. And whilst the bank was happy, and we were making good money, the reality was that I was starting to become a little bit disillusioned with the whole thing, because investing for me was a little bit more than just simply making a nice return. It had to have a meaning. At this point, my wife came to me and said, look, I have an idea. Now usually when my wife says that, I don't really listen, but I was a bit vulnerable at that point in time, so I listened. She had worked in health and social care for many years, and she said to me, look, the healthcare sector is in real need of people who know what they're doing. And I was kind of looking around thinking she was talking about somebody else. But she said, look, for people that know how to run a business, commercially astute, there are lots of opportunities to be able to invest, help people, and make a difference. I thought about it for quite a long time, but realized actually it made sense. And I left the world of banking, probably the timing was also good as well, and went into work in healthcare. I've done that for some 8 to 9 years now, and went on to run a number of services looking after people with disabilities, some with profound learning disabilities. Now, for me, that made a big difference. I now got to a point where I enjoyed investing. I could see the people I was helping, and the money that I was putting to use was making a tangible difference to people's lives. Now, for me, that's a very, very important thing, and I think that if we are in a privileged position whereby we do have funds that we can invest, we should consider that additional step of maybe utilizing our funds for a greater good. Now, I'm not suggesting everyone can go off and start businesses or stop investing and get directly involved in businesses, but this is where crowdfunding has now made a difference. Crowdfunding allows everyday people, ordinary people, investors, all types of investors, both professional, angel investors, people with some money in the bank that want more from their money than simply leaving it there or giving it to fund managers, faceless fund managers, losing fees. And crowdfunding allows people to do that. How does it work? Well, a number of you have come to see us this morning, and hopefully we've had a chance to explain to you a little bit about the mechanics. Now, investing in crowdfunding or becoming a crowdfunding investor is a very, very simple process. But as they say, a picture is worth 1,000 words, and hopefully a video is worth a little bit more. So I have a 60-second clip, which I would like to show you, which goes through the mechanics of being an equity investor, and then I have a 60-second clip, which will show you about the mechanics of becoming a loan investor. And I think you'll find that the images and the pictures are probably a little bit better at saying what I need to say than myself. So.
Do you ever feel your money is just lying around and not really working for you? If you want a good return, you need to look at opportunities other than savings accounts, which is where Funding Tree comes in. Funding Tree is an online crowdfunding platform that brings together businesses and investors without the need for traditional bank finance. With Funding Tree, you simply choose the businesses you'd like to invest in, decide how much you'd like to lend, and the interest rate that suits you. Crowdfunding works because it enables hundreds of other investors to all lend different amounts. Once a business reaches its funding target, we'll release the money and take care of the paperwork. We'll collect and deliver monthly loan repayments straight into your online account, and you can follow what's happening using our free online account management tools. All businesses on Funding Tree have been reviewed by our risk assessment team and rated accordingly, helping you decide how much reward you would like for the risk you take. It's free to sign up with Funding Tree, so why not register today and get your money really working for you? Are you looking for a smart way to make your money work? One that delivers potentially high rewards? Then why not invest in an exciting business on Funding Tree? Funding Tree is an online crowdfunding platform that brings together businesses and investors without the need for traditional bank finance. If you're passionate about helping to bring creative businesses to life and sharing in their success, then Funding Tree is tailor-made for you. It's free to sign up with Funding Tree. Simply choose the business you'd like to invest in and how much you'd like to invest, anything between £100 and the full amount. Once the business has reached its funding target, we'll release the funds and shares will be issued to all investors, giving you direct ownership along with the other shareholders. What's more, tax-saving incentives are usually available to investors in startups, so you could benefit from very useful tax relief. By investing in a portfolio of businesses, you'll not only be spreading the risk, but increasing your share of the rewards. And one of them may just be the next big thing. Funding Tree works because we enable hundreds of investors to invest in opportunities together. So if you don't want to miss out, register with Funding Tree today and look forward to potentially big returns.
So hopefully you can see that there are two distinct types of crowdfunding you can become involved in, but both of them offer the opportunity to actually have long-term investment objectives as well as short-term rewards if you're looking for shorter-term income, say through a portfolio of income-earning assets. Yeah? The important bit, though, is that crowdfunding is often misconceived as being just for businesses that are startups. At Funding Tree, we look at businesses which are both startup as well as through to established. And we can facilitate that because debt and equity transactions can be facilitated through platforms such as ours. It's interesting to note that every day UK businesses continue to seek funding. And in fact, 20 billion per annum is raised on behalf of SMEs through the various forms of finance that currently exist. So that's 20 billion per year that businesses are looking for in order to start, expand, develop, grow, acquire. And at the moment, as we've seen throughout the last couple of years, there are still significant barriers to entry for many of those businesses looking to raise that funding. Now, an interesting point is that many of these smaller businesses actually have very similar reward profiles, return profiles. Many of them are actually generating between 25 and 40% return on turnover. Now that's quite an interesting point because actually many businesses in the FTSE are only making around 5 to 7%, and through that they have to obviously reward investors through dividends, these sort of things. So actually lots of smaller businesses, whilst not glamorous in their appearance, actually have a slightly more higher tolerance to sustain fluctuations in business cycles. But these are everyday businesses that we see on the street. And the reason for that is that as consumers, we rely on a lot of these high street businesses on a daily basis. So greengrocers, hairdressers, local chemists, florists, and even if there are fluctuations in the business cycle, we still need these things. We still go to the shops to buy food. So these are the sort of businesses that are going to benefit significantly from the change in crowdfunding and its accessibility for investors. I want to show you 3 very different businesses that have successfully raised money through crowdfunding. On the left we have a dance studio based in Nottingham who were looking to raise a small amount, 20-odd thousand, to help renovate the facilities that they already had. They already had a number of students coming along that were learning tap, ballet, classical dancing. They had a dance academy there where they were trying to bring students in to start learning on a 1-year programs, and they were struggling to raise funding. Now, this business was already operating but did not feel that the bank would take them seriously. And through crowdfunding, they successfully attracted the funds they needed, plus a little bit more, and managed to return, as you can see, quite a successful amount to investors. At the other end of the spectrum, we also have a farm in Devon. Once again, for many investors, particularly those in the city, you may think, well, actually, this is not a glamorous investment opportunity. Why am I really getting involved in this? But that farm has hundreds of school children coming on a weekly basis to visit them, look at the animals, learn about how farming works, and once again, a very successful fundraise through the platform. They went for a 4-year loan, 48 months, and investors are receiving an average of 14.21%. So we've got 2 extremes here. And lastly, Funding Tree. We launched by crowdfunding our own platform. We raised in excess of £500,000 by talking to investors through the site, people that had registered an interest early on who were keen to become part of our story. Now, for us, that was very important to demonstrate that we understand that the private equity world, venture capital world, they exist. The business angel world, they exist. But this is proof of concept. This is proof that a startup with a good idea, with a good solid background, with the right team, and hopefully with the right story to investors can attract funding. Okay? So I wanted to just clarify and reiterate the point that diversity can be rewarding. It will be interesting to note that statistics from the government have shown that 71% of SMEs grew last year. And in fact, next year is projected to be 89%. Now, to put this into context, 99.9% of all businesses in the UK are SMEs. And by SMEs, what I mean, small to medium-sized businesses. These are everyday businesses that very often you as investors just don't get to see, don't get access to, and can't invest in. And the good thing is, obviously, these sort of returns are likely to remain consistent. As I said, through various stages of the business cycle, these are everyday businesses that everybody will want to continue to be involved in and continue to need. So is small businesses really an interesting sector to invest in? I mean, now that it's been opened up to small investors, what are the risks? What do we need to look out for? And are there bigger guys involved in this that we need to kind of pay heed to? Well, yes. Venture capitalists, private equity houses have been making lots and lots of money for many, many years by investing in small businesses. They make a living out of finding the next big business that they're going to put a huge amount of money into. For the very first time, everyday investors can now gain access to the sort of returns that they tend to make. To put it into context, VCs tend to put in an amount of money where they're looking to gain 10 times that investment over a 3 to 5 year period. Now, they're very, very selective about the sort of businesses that they back, but at this point in time, they are the only significant backers of smaller businesses. An interesting point to note, though, and this is a point which is often raised as a warning signal against investing in small businesses, is that 1 in 5 only succeed, so 4 in 5 fail. Now, that's a point I want to come back to and touch on shortly. Why is there an opportunity with crowdfunding? Well, there is still a significant gulf between the supply of money and the demand for money. What I mean by that is anything sub £1 million, in reality, banks and venture capital groups are not really interested in putting their money to work there. And the average everyday business is looking for somewhere between 50 to 100,000 pounds plus. So there is a significant gap that remains, and that will continue to remain. Now, why is that the case? Well, if you are an institution such as a bank or a VC house, then you need to conduct quite a significant amount of due diligence in terms of looking at the businesses, assessing them, determining whether you can not only invest, but will you make your money within 3 years, because that's typically the time that people want to exit if you're a VC fund. The other thing as well, if you're a VC house, you can't afford to monitor many investments. You'll only have a portfolio of maybe 10 to 20 that you can keep an eye on. So actually that gulf remains, and it's been clear and it's been told to us a number of times that anything sub £1 million is just not efficient. It's just not worth them looking at those. And actually the fees they make on any investment less than £1 million isn't enough to pay for all the fund managers that are there. So opportunities continue to exist. And there are many opportunities out there. As I said, 99.9% of businesses are SMEs looking, and they're all there looking for funding. The government is also giving generous tax breaks to investors in SMEs, and my colleague Tom will touch upon that shortly. So the EIS scheme and SEIS scheme, as well as proposed changes to the ISA rules which are coming in. So an important point is that the government recognises that businesses, UK businesses, are the engine room of the UK economy, and that we need to support these businesses in whatever shape or form we can, even if the banks are not. Right. One of the important bits about crowdfunding is that you ultimately are in control of your investments. An example here is the pitch overview page on our platform. So you can see there's quite a number of different businesses there looking to raise either equity or loan for different amounts of money, different types of businesses, from a mobile app through to a property development business, through to a music venue for start-up bands, a business which makes workwear for industrial businesses, a furniture maker, and an interesting technology business which is aiming to establish itself effectively as the Facebook for the educational world. So you're in control of what you can put your money into. First, you just have to pick, do you want a loan type return or do you want equity type returns? What makes sense to you? What sort of industry do you like? Yeah. Another important point here is that on the left you can filter out by type of industry. Some people like to invest in industries that they feel particularly close to, industries that are in the community, industries that if they have a strong belief in technology they can filter those out, or simply just say I only want to invest in loans or equity. So once you've decided what sort of business you like, there is a checklist that you need to go through, and it is a very different process to investing on businesses on the stock market. There are lots of similarities, but there are certain things that you can do through our platform and through other crowdfunding platforms that actually allow you to make that informed decision. Firstly, determine what it is that the business does. Now, if you're not familiar with certain industries, it's quite important that you make sure you only invest in the businesses that you feel comfortable with and you can assess the risks appropriately. So, for example, a mobile phone app is it's obviously a technology play. If technology is not something you tend to put your money into, then don't. You don't need to. But something like a furniture maker like Oak and Iron, which has a very simple business model of making bespoke furniture, commissioned pieces, with a great team that has a track record of having done it for many years, that might be more straightforward for you and something that you actually feel more comfortable investing in. Most important point is you are in control. Next thing, are they a startup or are they an established business? Obviously, that's important to note because the return profile that you can expect from that business will be influenced significantly by that fact. A startup, by definition, will not be able to reward you with either a dividend or any regular payments until it beds itself down. Whereas an established business, which is potentially looking for a loan, could quite easily afford to make those repayments immediately after the first month. Very important point, why does the business need the money? It's up to the business to make it very clear what they intend to do with the funds. Usually it's for growth, for acquisition,